Good morning, this is Mayor Valensky with Driving Markets. Hope you're all well. Just a quick caveat before we start. It's been mentioned by one of the viewers and some colleagues within the UK. They should put a warning on there. The warning is very simple. Everything said on this particular piece is an opinion. I'm not a financial advisor and I'm not out there to give you advice whether you should go long or go short. Everything stated is an opinion only, and therefore if you do take upon that opinion and you make money, great. If you lose money, then you're not holding me responsible for giving you advice. That covers me on that particular point, and we're going to state this on every video going forward. We don't want my lawyer start getting 300 lawsuits, so you said this and you said that and etc etc. You said Bitcoin going to go up and Bitcoin's going to go down, and FX and Japanese yen and dollar yen and whatever the case may be. So just take it as an opinion. Okay, so let's move off. So yesterday, the big item on the agenda was the FOMC minutes. That's a minute recording of what happened in the June FOMC meeting when they raised rates by 75 basis points. And the Fed came out and said clearly that we are going to tackle inflation aggressively. And as a result of that, the markets liked it. The markets liked the fact that the Fed is taking firm action, even though the Fed stated that their action could cause a slowdown in economic growth. They're going to take aggressive action. So I'll give you my opinion. My opinion is that the action it's too late, will not be sufficient, and they'll have to continue it over the next 18 months. So I expect interest rates in the States to be anywhere between 5 and 6%. Again, as I stated at the beginning, in my opinion, and that is going to drive the dollar much, much higher. In addition to that, look at what's happened to oil. Oil has come tumbling down on the back of recession fears. We're not even in a recession. There's no official number come out that we are in a recession, but the markets fear recession. So the fear is what's driving markets, what's driving oil lower. So there's no absolute numbers. There's no confirmed negative GDP for 2 quarters. Europe is suspiciously going into recession. America may go into recession. The UK may go into recession. And all this may go into is pushing, driving markets complete into volatility and much higher levels of erratic behavior. So oil has come tumbling down all the way down from $107, $108 a barrel to around about $96 a barrel. And that will obviously have a big impact if it's sustained on inflation. And there's some people say that inflation has topped out. So many investors and traders and professionals on Wall Street have said inflation has topped out at this level. I actually don't believe it. I don't accept that. I think inflation has not topped out. What we are waiting for is we're in between news already priced into the market and other news coming out that will affect markets. And the other news coming out is going to be that corporate earnings are going to be affected as a result of the slowdown in economic cycle. And that's going to have a big impact. So there's a lot of things out there that we don't know about. But however, one thing I am pretty sure about is that we're going to have ongoing inflation for the next 2 to 3 years at much higher levels than we have at the moment. There's some things that you've got to look at the horizon, the clouds on the horizon, in terms of concerns. Number one, you've got Putin is threatening further action amongst other neighbor states. That is a big factor. And also you've got instability in the UK with Boris Johnson, no confidence votes, etc, etc. That will have an impact on the UK and on GDP. Furthermore, the high-tech sector has been laying off people or freezing recruitment now for several months, and that's going to have a big impact on the overall economic cycle because their revenue is falling away, and as a result of their revenue falling away, then there's less circulating around in the economy. Remember, the markets have been driven higher by the overall high-tech sector, which pushed markets higher over the last 10 years because of the speculative investments within the high-tech sector. And it's going to be the high-tech sector, as I've stated again, that's going to push the markets or drive the markets down. So you've got to keep an eye on that. Bond yields jumped yesterday. They were down for the last 4 or 5 days. They jumped yesterday. Now a lower bond yield on the 10-year bond will push the Nasdaq higher because that's where they borrow their money. They borrow their money based on the yield of the 10-year treasury. So if that yield is down, then the Nasdaq and the high techs will go up within financial markets because they're looking at longer term borrowing. However, we have had an inverted 10-year and 2-year bond, and that is a indicator again of recession. You remember a while back on my YouTubes and driving markets, I stated an inverted 2-year 10-year with the 2 years higher than the 10-year, that indicates recession. That happened again now this week, and that also concerns markets. So you've got to keep an eye on the 10-year and the 2-year yield. As regards other factors, you've got the normal, all the FAAMG, the FAM shares, the Facebooks, Apples, Amazons, Meta and Google all went up yesterday on the back of solid Fed minutes. I said they're going to tackle inflation. However, I would be a seller, even though markets are quite quiet, I'd be a seller generally of high tech and anything that's high risk, because it's likely to go down further as rates rise. Okay, that's a bit of background. We've got non-farm payrolls out tomorrow, massive number, keep an eye on that. Again, the caveat is everything on this video is an opinion only. You can catch me on YouTube, WhatsApp, Twitter, Instagram, all of them are opinions. Have a good day, catch you later, all the best from Driving Markets.